I tell you, Jeff, I don't see anybody. Hey, whose person is yelling in the background, Roxy?
Not me.
Oh, that's probably me.
Get your family to shut up for just a little bit. Everybody, we're letting everybody in right now. Hope everybody's doing well. I see Nicole, Bob, Ryan Sifford's looking dapper. Brian, I got some pictures I got to show you later. Send me an email. Show you some new stuff we're working on. Dave Ramsey. Oh my God, everybody, this is a treat. You guys, I've become fairly popular. I have Dave Ramsey and Paul Bunyan I see at the bottom of the screen with the beard. He knows who I'm talking to. If you guys have not actually officially met the Dave Ramsey, he's a personal friend of mine. And as a favor, I asked if he could join. So I'll let him chime in a little bit later towards the end. But you guys should be honored that we got Dave Ramsey on here. And I'm not charging you guys for him. I should. Sasha, good to see you. I'm going through people I can see. Kurt Jordan, he won't show his face. Bijou won't show his face. Look at all these people that are afraid to turn their cameras on. Let's see. We're going to wait a couple minutes just to make sure everybody gets a chance to sign in. We muted everybody for right now. If I want to say hello, I'll unmute you. We muted everybody because 4 times ago, some lady wasn't on mute and her husband asked what was Meryl saying, and she said, hold on, I need to unmute Greg because I can't remember exactly what she said. Greg, unmute yourself.
I believe she said that Meryl was just fucking around.
Yes, that was a good quote. Yeah, she said, he goes, what's Meryl talking about? Oh, he's just fucking around right now. So at that point, I decided, hey, everybody, I'm done fucking around. I think we'll talk about law. But I try to give everybody a few minutes to log in. Jeff's still adding a bunch of people. Tonight, we're going to talk about funds. And some of you know me. I can start talking and continue talking. So I'm going to have Cindy help moderate. She's got a copy of the presentation. It's possible we may make a part 2 of this next week. I'd like as close as I can to a hard stop around 7:15 and give you guys a chance to ask questions. Cindy, if you happen to see questions, or Greg, you happen to see questions while I'm talking, maybe interrupt me, especially if it pertains to what we're talking about, because it's much easier to either answer them or tell them we'll talk about it later while we're talking about that topic.
Yeah.
Yeah, we're going to go into some detail. I'm going to go into some detail about like literally everything you would want to know about a fund and what scenarios you might have when you don't even need to set up a fund. We've had quite a few of those. I wouldn't say quite a few. We've had, let's say, 6 or 7 of those lately where it turns out that a syndication is not necessary because it doesn't appear to violate any of the SEC rules. So we're going to go through, and as everybody knows, this is not intended to be legal advice. This is for entertainment purposes only. That's why I joke around and I make jokes. This is actually a comedy show that has very good information about laws, and you should always seek your legal counsel and or tax advisor if you have specific questions. Obviously, we're available. You guys that know us know that you can pretty much email us for a quick answer about anything. So let me see how many people are logged in. Give it like 2 more minutes. Let me see who's out here real quick. Let's see. Shirley's on. I see she's listening. Matt's on. Dave Ramsey. Hold on. I got to unmute Dave Ramsey for just a second. How do I unmute Dave? Here, Jeff, clicking through. You can unmute Dave real quick. Dave!
What's going on?
Guys, this is a treat. I have the Dave Ramsey on the mic or on the camera. Dave's a buddy of mine, and everybody knows Dave Ramsey. And for those of you that have never met Dave Ramsey, you're in for a little treat. It's not the Dave Ramsey. Actually, he is the Dave Ramsey. There's another Dave Ramsey that seems to be a little popular that tries to take his name away.
Yeah, clearly. I had mine first, so we'll.
Yeah. Hey, Dave, since normally this is a Tuesdays with the Teams happy hour, and I highly encourage, as we start talking, I highly encourage everybody to share their contact information, maybe a little bit about themselves in the chat box. We normally expect people to mingle. And and please don't put deals in there, because I don't know if you guys are doing 506Bs or 506Cs, but you certainly can say what you do, what you're looking at, and contact information. We're going to make this presentation available later. Dave Ramsey is your specialist for, Dave?
Cost segregation and 179D studies lately. And I can probably need to talk to you about that.
Yes, I know you do.
In the last, in December, the last week of December, in the extender package, they passed something called 179D. And for those of you that are switching out your HVAC or lighting in your multifamily, which some of that stuff you would have to do a 27.5-year depreciation schedule. So you can get up to a 60 cents or actually up to $1.80 cent per square foot deduction on your property. So it's going to expire again at December 31st. For those that are doing new builds, there's something called 45L, which is up to $2,000 a door tax credit. So
I need to talk about that.
Yeah, we need to definitely, we can do something on that if you want. I can get high.
Yeah.
She's much smarter and prettier.
I think I think we'll do is I'll have Rob and Roxy reach out to you afterwards, and we're gonna ramp up the You Can't Fix Stupid real estate podcast. We had a lot of good feedback, and that's a little more entertaining, but also more one-on-one on topics. So if you're willing to suffer through our sarcasm.
Yeah, absolutely. And something else, if you want, I don't know if you realize, my CEO, Julio Gonzalez, who you probably see on Fox Business and OAN and America's Voice.
Well, I only watch CNN, you know that.
I know. But he is on the President's Tax Policy Committee. We are very involved with the CARES Act stuff, and he can probably give maybe a 20-minute let you know what's going on in Washington kind of thing, on what's on some of the lobbying stuff that we're doing with regard to real estate and trying to get some new things. We're trying to get bonus depreciation permanent, which would be nice.
Yeah, that would be nice. So everybody make sure you vote, because there's only one direction where we can make it permanent. And I'm not going to.
I heard Kim had a real fun time with the worker at the house.
Oh, please. We're not going to talk about my wife. My God. So I got to tell you guys, I don't think James Ng is on. It was the funniest thing ever. And then we're going to start, I promise. But I like to start off a little bit of humor. So most of you that follow me on Facebook page, we bought a house because, I'm not going to say why, but we downsized, went into a high rise in North Dallas. COVID came. Everything we were paying for extra in this high rise we couldn't use, and elevators were too small or on the 20th floor, long story short. So we upsized after downsizing and bought a house. Great deal. Started with a budget. This is really funny. My wife decided she was going to be the general contractor, like literally the general contractor. And so we started with a budget. I'm not going to tell you what we started with, but we're about 2 times the budget. And we finished the budget, and we're about 95% done with the house. And so James Ng, who works with Old Capital, sends a message and says, hey, we're thinking about remodeling our kitchen. We gutted everything downstairs, about 3,800 square feet downstairs, just gutted it, literally gutted it. And James Ng says, I'd like to know if you'd be willing to share your general contractor with me, and if you get me some information. And so, like a good husband who's been married 24 years, I asked my wife if it's okay for me to be my sarcastic self on the response. And she said, yeah, go for it. And so I told James, I said, listen, let me warn you, the contractor is a real bitch. I have had to work with this contractor for 25 years now, and very, very difficult. And so he says something to the effect that, oh, that's cool. If you can give me her name and number, we'll figure out how to work with it. We really like the work. I said, James, this is my wife. There was no contractor. It's my wife. You do not want to work with my wife, especially right now. She ripped into a handyman that we hired yesterday. He had the wrong attitude in the house, apparently. And 5,000 of my Facebook friends know about it now. So anyway, we're going to get back to our regularly scheduled show, if you guys are ready. Jeff, everybody can hear me, right? You guys see the first slide, Tuesdays with the Teams, Funds 101, 102. We've got Cindy Merlis joining us and our favorite Greg joining us. Greg's our worker bee. He's the guy that actually thinks Cindy and I are the, we're just kind of the eye candy. Greg does all the work. But I'm going to have them interrupt, hopefully every once in a while. I'm going to go through some stuff fairly quickly, touch a lot of different topics about funds. A lot of these are questions you hadn't thought about, I'm pretty sure, but we're seeing a lot of interesting structures, interesting questions right now because we have gone through COVID. There are different opportunities. There's different types of money out there available. When I say types of money, capital, there's new capital coming in that's not familiar necessarily with multifamily. So we're getting a lot of interesting structures and whatnot. Jeff, make sure you're letting people in. I see about 17 people up there. Or maybe that's 17 messages. They're going to also interrupt me if there are any messages, and I may have them chime in. So if you guys have questions on certain topics, to the extent we can answer them, we will online, or I'll answer them while I'm speaking. This may go to a part 2 next Tuesday because I think the information is very important. I have a 12-page, fairly detailed outline of everything we're talking about. So we're going to make that available when we're done with the presentation. So if it doesn't finish till next Tuesday, great. Again, I want to do kind of a hard stop, probably around 7:15, unless we have tons of questions. So wherever we stop, we'll pick up next Tuesday. If I can get through it all, great, but I don't think I can. So I'm going to start off real quickly. We're going to talk about basically funds. What is a fund? And I'm going to give you the lawyer answer. It depends. That's the definition. It literally depends. It depends on what your intentions are with your partners and whether or not you have a sufficient amount of capital to cover your capital needs when you form your entity. Basically, how much money do you need? How are you going to raise the capital? And what type of entity you're going to use? You're going to need financing. To be clear, if you guys are taking passive investors, you're most likely selling a security. Passive investor in the form of a real estate investment perspective is an investor that simply puts capital into a corporate structure and has zero control or managerial duties in that corporate structure. So if Dave Ramsey invests, sorry, Dave, you just happen to be at the bottom of my front screen. If Dave Ramsey invests $100,000 in How We Cheat 'Em and Why fund that I just created, and he has no managerial duties, he's a passive investor. And I cannot sell Dave an interest in my fund unless I'm a broker dealer or an RIA, or I have filed for an exemption under SEC. So anybody that you are going to take capital from that is going into your LLC or your LP and not part of the manager not doing managerial duties is going to be considered a passive investor. To the extent you have specific, legitimate, significant duties that are part of what the manager would normally do, you may not be a passive investor, and you're most likely not going to be a passive investor. But in that case, as the investor, you need to make sure you understand that by having those type of duties, you are subjecting yourself to liability. And most people who want to invest in a real estate deal that's already put together by syndicators are doing it passively. They don't want the liability, they just want the money. So can I put together a corporate entity without syndicating? We get this question more often than you would think we would. I think Cindy and Greg can attest to that. The short answer is yes. You can create, You can't put together a corporate entity to buy an asset without syndicating. It's yes with a caveat, big caveat. Each partner, member, or shareholder should be part of the manager or managing entity with managerial duties, responsibilities, and liabilities. And again, passive investors typically invest in other people's deals. So what that means is when most of you guys form, if you're a syndicator, you form essentially two LLCs. You form the LLC that's going to buy the fund, that's going to be the fund, it's going to take in the capital, it's going to own the asset. And then you form a managing LLC. It's the manager, not property manager, but it's the manager of that fund LLC. And whoever sits up in the manager has 100% of the liability. If everybody that's coming into the deal as an investor, and typically these are small deals, either small deals or a few people with a lot of money, they come into a deal and each one of them is also doing some of the actual management of the fund, not property management, but asset management, and is signing on notes and doing other things. They would pretty much be in what we would call a member managed LLC. Occasionally they'll still set up two separate LLCs. It may be overkill, but that's a member managed LLC. And in that scenario, they most likely don't have to file for an exemption under the SEC. And in that scenario, based on the facts, they're not selling a security because the investors are not passive. So an example, I was kind of using Dave Ramsey as an example, but I don't want to pick on Dave yet. Let's say 5 people decide to invest $200,000 each. Each investor is also an owner of the manager or in a member managed LLC that has specific duties associated with operating and managing the fund. In this scenario, there probably is no selling of securities, therefore no need to syndicate. It saves legal fees, which is something you will rarely hear me say as a lawyer, because we make money off legal fees, but we also look for long-term clients. So we're telling you, rather than paying for a syndication, if you have a smaller structure, and there's somebody on here right now we're doing one with right now, you can avoid the extra tax return for the extra LLC, somewhere between $5,000 and $10,000, maybe even more, maybe $12,000 to $13,000 for the syndication portion. And you can form a small LLC. Everybody's a manager in the LLC, and you can go take down the asset. You just need to understand that everybody in there will have personal liability. Now, we get questions on it, but 9 times out of 10, the people asking these questions will not qualify as a true, we'll call it joint venture partnership. It ends up being they're selling securities. They're trying to do a little workaround. We're going to talk about the little workaround. I'm not going to go into specifics, but you need to be very, very careful if, number one, as an investor, and 2, if you're a syndicator. We see these all the time where someone is offering a small interest in the GP, let's say 1% to 5%. Sorry, Dave, if Dave Ramsey brings us $1 million, if Dave brings me $1 million into my fund, I'm going to give him 3% of the GP. You guys think that's legal? Luckily, I can't see any of you. So I'm going to assume you're shaking your heads no. That is not legal. That is illegal. That is paying somebody to bring in capital, and the only people you can pay to bring in capital are broker dealers. So that is going on in our world. We see it. There are quite a few investigations going on that we know about in certain deals out there. So we're trying to make sure everybody understands that that's an issue. The reality is that offering any interest or compensation to a non-broker dealer is probably a violation of securities laws unless that person has legitimate managerial duties. Greg, would that be accurate?
I would agree.
Yes. Greg and I have had to rewrite some people's expectations, some clients' expectations. So basing an amount of a GP interest in direct proportion to how much capital a group or entity raises, who's not a broker or dealer, again, I want to stress this, may be a violation of security laws. And so some of you may think, oh, okay, it's not a big deal. Well, if that becomes an issue, and if you get called up by the SEC, and it won't be called up, you'll be sued by the SEC, first investigated, then sued, more likely than not, you'll never be able to raise money again. So it's not a slap on the wrist. It's a punch in the face about 400 times. So it literally is not worth it. And I want to emphasize may be a violation because there is a gray area, which Greg Anthony and I have dealt with on several clients recently. You have this kind of pay to play, or I hate to use the word kickbacks. I always tell people not to use the word kickback, but it kind of seems like a kickback scenario where people try to get around this licensed broker requirement. It's where you offer kind of these quasi managerial duties where the reality is no one's really doing anything that the manager isn't already doing. And you try to kind of couch it in, oh yeah, they're going to be in charge of investor relations. Primarily the investors that they're bringing in $3 million worth of investors. They're going to be in the manager, you know, a 3% or 1% or 10% manager, and they're going to oversee those investors they brought in. It doesn't really work like that. That's most likely not going to qualify. We already know of 2 very large investigations where that doesn't qualify, but it is gray. I would say it's dark gray, but it is gray. So we try to advise people not to do that. And if they're adamant about providing some sort of compensation for someone bringing in money, they need to really structure it in such a way that that person or entity is truly a manager, taking on the responsibilities of a manager and the liabilities. So we're happy to talk to people about it. I don't know if there are any chat questions about that, Cindy, but we're happy to talk to people about it. But our general advice is stay away from the pay to play. It's tempting. I know it's tempting when you have that last $1 million or $2 million to raise, but the temptation will literally kill you if you do it the wrong way, or you say, screw it, and something happens on the deal, SEC comes in, it's not going to be good for everybody. Okay. So we talked about why a fund, when to syndicate, which is when you use an exemption under the SEC because you can't sell securities without a license unless you use the exemption, and then when there are opportunities for you to actually bring in capital without having to utilize exemptions. And again, that would be when you have, let's say, 3 to 5 people. You get more than that, it becomes very difficult to manage a deal. 3 to 5 people, each one wants to put a couple $100,000 in. They're all going to be part of the management, truly part of the management. And so, you know, you're up to 5 people, you're up to $1 million. You go get financing for 3. And you go buy yourself a $4.5 million asset without having to do a syndication. Again, talk to your lawyer, us, or whoever is doing your real estate and syndication work to verify that you meet those requirements. So I'm going to flip over to what types of funds. We've given a whole deal, a whole hour and a half we spent. Sorry, it's thundering outside. A whole hour and a half on types of funds, single purpose funds versus blind funds. I think we did an entire session on blind funds, which seem to be very popular right now because there's dry powder out there. But let's talk about single purpose funds real quick. If I can get here we go. Single purpose funds they're pretty simple. It's one asset, one capital raise. I'm going to go buy 123 Main Street. I need to raise $5 million and I'm going to get $15 million in financing. And those are the most common deals that we see. They're the most common deals, the common structures that you have with multifamily, strip centers, storage facilities, mobile home parks, you name it. They're preferred by most agencies and conventional lenders. They like the single purpose entities. Your PSA or your purchase and sale agreement is typically executed prior to the formation of a fund. So depending on the structure, the exemption that someone takes, whether 506B or C, which we'll talk about a little bit later, most syndicators will wait until the PSA is signed. And quite honestly, they've gone through most of the due diligence period before they even start to raise capital. Because the raising capital can be expensive. It's very time consuming. And you certainly don't want to start raising capital and taking capital in if the due diligence turns out that the property is a dud or you've got to renegotiate. So typically we recommend to our clients, you don't form an entity until after due diligence, or once you're in due diligence, you know you're moving forward. Yes, we're still going to do the real estate work, get through the purchase and sale agreement, and most of you are going to buy it either under an existing entity and assign it to a new entity. They're going to buy it under your personal, under your individual names. You're going to assign it to a new entity. To the extent you don't move forward during due diligence, we don't want you to have to file an LLC that then form an LLC that then creates tax returns that you didn't need to have. So It's funny, a lot of people get annoyed with us because we strongly, strongly resist their temptation to just go ahead and file an entity the day they have their PSA. And those that have had issues in due diligence and didn't move forward, thank us constantly because we're so annoying. The reality is we're one of the few law firms, we actually try to save you money, or I should say, prevent you from spending unnecessary funds until it's time. And we can typically get an LLC done in, even with the COVID issues going on, 48 to 72 hours. I mean, so it's not as time consuming, and you definitely will save money. The other reason single purpose entities or funds are so popular, less experienced sponsors can jump right into them. That takes all of the guesswork out from investors. You know, especially if you're a newer syndicator and you don't have a whole lot of experience. So the investor really doesn't have a whole lot to look at you with respect to, okay, is this going to be a good investment or a bad investment? But what they do have to look at is the actual asset you have under contract and the numbers on the history of the asset you already have under contract. So by having a single purpose entity with one asset targeted, it allows less experienced sponsors to be able to raise capital a lot more efficiently. I'm trying to see if I missed anything else. That's pretty much it for single purpose funds. Like I said, I have a little more detail in our outline that we'll present later, but that's pretty self-explanatory. Everybody wants to know about blind funds, but most people, once they hear about it, don't want to do it. And I think in the last episode we did on blind funds, I must have said at least 10 times, they're not for everybody. And if you don't understand it, you shouldn't do it. And the majority of people don't do blind funds. With that said, 6 out of my 8 funds I've done personally are blind funds because I like to have the flexibility. And so in a blind fund, it's actually, if you've got history or you've got an exceptional team, they're fun. I think they're fun. Maybe I'm kind of a sick individual, but I personally like blind funds. What you do in a blind fund is you have targeted parameters. You don't have how we cheat them and why apartment complex on the end of the street. What you have is you're targeting 1970s to mid 80s build, pitched roof, median income in the real estate track is between 60 and 80,000. You're looking for 150 doors to 250 doors. Want it to be in an MSA with a low tax rate, blah, blah, blah. So you're putting out not generic, but general parameters, not too broad, but not too specific. And you're saying, okay, guys, gals, this is what we're going after. Okay. And, you know, whether I'm looking for a lure property or a non-lure property, what this does is it gives the potential investor an idea of what you're looking at. On the flip side, because it's a blind fund, they're going to rely more on your past experience and your judgment because there is no asset for them to rely on that's under contract. So typically you have a little more of your experienced syndicators that will go after blind funds. Now, we get brand new people all the time saying they want to do a blind fund. Greg's nodding his head yes. That's a pretty weak nod, but yes, Cindy's nodding her head yes. So we get that all the time. It's funny, I think they get more upset with me, not the people, but my team, because we'll talk them out of actually moving forward because we don't want to see them spend all this money to end up with a big goose egg. If you've never done a deal before and you're going to go out and start your own blind fund, good luck. It is not fun. It is not easy. And there are too many opportunities out there for investors that in their minds are a lot lower risk because they've never worked with you and they've never seen anything you've done. So one variance that we're seeing a lot of right now to blind funds or opportunity funds. It's not really a legal term of art. An opportunity fund is a blind fund. It's great to call it an opportunity fund. You're just taking advantage of any opportunity that fits in your parameters. But it's very sexy to say, I'm doing an opportunity fund. Or my fund is opportunistic. I'm saying that because I use that in almost all of my funds. They're all opportunities. When the opportunity shows up, great, you go after it. Especially with what's going on with COVID now, despite what I see on social media, people are getting deals at 15 to 20% below value right now. I don't care what you're hearing from, I wouldn't even watch social media for news, but I don't care what you're hearing at all. People are getting deals, and many areas are not collecting 93, 94, 95% of rent. They're not. And what that's doing is it's creating a much better valuation for buyers out there, better selling purchase price for buyers out there. Now, with that comes some hair. You know, if you're not at 80% economic occupancy or higher, financing becomes a little tricky. But if the price is right, you just get more, you have more capital, and you get less leverage. And then when you stabilize your property, then you try to refinance out or add a supplemental loan. So we have seen a huge uptick in business in the last month, and majority of these are on opportunities that actually existed right around when COVID started, but they've all come back and retraded for much lower pricing. So people should be out there looking at deals. I understand why people are putting together or wanting to put together blind funds and opportunity funds, because these deals are moving quickly and they want to show that they've got capital in the bank. And it's always easier to go to a broker and show a bank statement with a couple $1 million or $3 or $4 million in when you're going to make an offer on a property than showing $200,000, which just covers your hard earnest money. It's the way it is. That's why some of the bigger groups get some of these deals. So great opportunities out there. You got to jump quick. And then under the blind fund, you can do either a single or multiple asset deal. A blind fund doesn't have to be one asset. I've done a blind fund with 300 single family properties. We bought them one at a time, raised $5 million and got leverage of another $16 million. And we bought 300 single family homes one at a time. Say one at a time, we were buying 2 or 3 or 4 a day for the first 3 months. But the bottom line is, if you have the ability, if you have the staff, you can go after more than one asset in a blind fund, where you can continue to raise capital in a blind fund. But again, that's for more experienced syndicators. You should most likely strongly encourage you to do several single purpose funds to begin with before you try to tackle that. It can be confusing. It takes an entire team. And then when you try to do a deal, here's the other thing you guys need to think about when doing a blind fund. I never even hit the slide. Cindy's supposed to catch me on that. This actually helps guide me.
Questions, Meryl, when you want to
Okay,
take.
I'll stop after the last bullet point. So one of the things to think about with a blind fund, guys, is you're raising capital, and you're raising capital for something that doesn't exist. So is grandma going to want to give you $100,000? Because it's $100,000 a unit. I'm just making the number up. Is grandma going to want to give you $100,000 a unit today when your PPM says you have 6 months to go find an asset? Now, grandma, who doesn't have as much time on the back end as other people may have, may not feel very comfortable having $100,000 sitting in an account that at best case is earning 0.5% a year in interest. So one of the things that we have people do, and that I've done in the past, is we structure a portion of the unit to be funded upon closing. So it could be 10%, 20%, 50%, could be 100%. But if you want to increase the amount of money you raise up front by taking a percent of the full amount up front until you have the asset in play, you most likely will get a larger commitment than you would otherwise. So for example, if I'm selling units at $100,000 a unit and I take 20%, that means when Cindy goes and puts 100 grand into this deal, she signs a subscription agreement, she's putting 20,000 up front on day one. And then as I find assets, I do a capital call, not an unlimited capital call. I'm just calling the remaining amount of capital that she promised. So before anybody types in a question, because I know what the next question is, well, what if Cindy decides not to pay the other 80%? This is a harsh reality, but we highly, highly recommend, and I build in a penalty provision for those that don't pay their additional percent. It could be as harsh as you lose 100% of the money you put in, and that gets distributed amongst the investors, which is pretty harsh. Or we take 10% of what you put in, distribute amongst the investors. And if you put in 20 grand, you have $18,000 worth of a unit now. You have 0.18 units instead of 0.2 units. And, you know, we keep going about business. You incentivize those who might want to back out at the last second by incentivizing them to not want to back out, because the reality is they signed a subscription agreement, which is a binding contract, and you are relying upon that subscription agreement when you're going out and making an offer for a 23 or $30 million building. And so if you don't have the opportunity to raise the cap or you thought you could, that puts you in harm's way if quite a few people decide to do that. So that's one protection. The other protection, quite honestly, is the last bullet point, your open period. So on a blind fund, you can put, I'm going to raise capital for the next year or 2 years or 3 years. That's up to you. We always structure it very, very syndicator friendly, where, you know, we're going to keep the fund open for a year, and then the syndicator has the sole right at his or her discretion or its discretion to open it up for 2 additional 1-year terms, depending on whether it's a multiple fund or not. The other reason I like to keep an open period on a blind fund is if you get some of those PITAs. PITA is a legal term, pain in the ass. We use it a lot. So if it's not bread, if you get a PITA and or you get 10 PITAs and you only get 20% of their initial 100%, well, your fund is still open. You can go and pick up a couple other investors. It's not closed. You can still go raise capital. So we like to encourage people to have an open period. They can always shut the fund down as far as raising capital, but it's much harder to ask all your investors to open it back up. Cindy, questions?
Yes, and this one, there's 3 questions. I'm going to do the second one first because it ties into what you're just talking about, is how long can capital sit before using it?
So here's the funny thing. That's a good question. So capital doesn't get stale, but the owner of the capital gets very stale. So capital can sit for years. The patience of an investor, it's very, I would say funny. It's really not funny. So most people will put in their blind funds that it will take us up to 6 months to put a property under contract, okay, or LOI. You want to give yourself plenty of running room. You put that in your PPM. If you're a 506C, you're advertising. If you're a 506B, you're presenting that to your core group of investors, and you stress, I may not get anything for 6 months. This is to make sure we have plenty of money to put down, and that we know we'll have the funds when it's time to close. So everybody loves it. Everybody signs up for it. And within about 2 weeks, you start getting phone calls. Have you found anything yet? And then 4 weeks, you get about twice the phone calls. So I was just wondering, have you found anything yet? And these are the same people that are receiving your monthly report, because especially when you've got their money and nothing's going on, you've got to give them some sort of status. And I encourage every 2 weeks to give a status, especially when you're sitting on their money. 6 months is an eternity for them, an absolute eternity. So yes, you can, 6 months is kind of the general guide. Some people put 3. We've had a couple clients put a year. I don't know how they raise capital, to be honest with you. I wouldn't put it in unless the potential returns were so great, but your money's sitting there and it may never be used and be handed back to you. So you lose 2% on inflation, and then your opportunity cost of doing another deal. And then, you know, when we have Dave Ramsey on our show, he'll tell you about the depreciation expense you didn't get to take advantage of, and 179 and, you know, all the other numbers. But anyway, so I hope that answers that question, Cindy.
Next question is, do you see more blind funds in single family rather than multi?
Is that a trick question?
That was from Dave Ramsey, actually.
So Dave Ramsey asked if I see blind funds. Really? That's, yeah. So what we do, I think I'll speak for both Cindy and Greg. I think what we do is we see a lot of people coming to us right now wanting to do blind funds. And the reality is what they think is a blind fund is not really a blind fund. They already have a couple properties they're playing around with on LOIs. And so I think they're kind of misconstruing the concept of, okay, if I raise capital right now, you know, and I get that LOI, you know, that's a blind fund. Not really, because their fund they're putting together is describing the asset they're going after, the specific asset they're going after. It's not really a blind fund. You're marketing the asset you're going after. But to answer kind of the second part of the question, there are more people doing blind funds in the last 6 months than we've probably had collectively in the last 5 years. I think that's probably safe to assume,
Yeah.
Cindy, Greg?
Yeah.
Me excluded, because I always do blind funds. What else you got?
And I think this is a good, just a clarification question for people that may not know the answer. Are multifamily syndications an example of single person/asset fund?
Greg's nodding his head. Greg, we'll let you speak.
I would say yes, 100%. That is a perfect example of a single purpose or a single asset fund.
Yeah, and multifamily, quite honestly, could be a fourplex. It could be an eightplex. It could be 400 units. It could be 300 units. I might argue that 8 fourplexes on the same parcel is the same thing as a single purpose asset. Yeah, they're 8 fourplexes, but they're probably already put together as one multifamily. It is by far the most common way to raise capital. There's discussion about crowdfunding, but you're going to be limited to $1,070,000 right now. And the requirements for crowdfunding, you would never, ever want to do it. We're having discussions right now with a couple groups that want to do it. There's a lot of misconception out there about crowdfunds. So I am going to talk next. This is still part of funds. This is the topic I absolutely hate the most. But we have quite a few clients that do it. Hate is a strong word, dislike maybe. These are called ticks. And they're not the things that bit Jeff on the foot last night. He was complaining about 2 bites. Ticks is a tenant in common agreement. I would argue that Greg is our resident expert on ticks, but I'm not going to put him under the gun. So I'm going to go over some things generally about a tick, so that 1, you don't ask, can we do a tick? Or 2, you understand when a tick makes sense. And then we'll probably talk about some of the cons of doing a tick. With that said, we have clients and I have friends that have done very, very, very well in ticks, but it takes the right type of group to do a tick. Ticks, I will analogize with marriage. And I don't know, we have 100 and some odd people on. And so let's say we have 100 people on, 51 of them are divorced. And I guarantee you at least 50% of ticks are ending up in litigation. That at least is what we've seen on the personal side. But the other 50% that don't end up litigation do very well. So tick, generally, it's a tenancy in common. It's an investment. Investment is an investment by the taxpayer in real estate, which is co-owned with other investors. So you actually own a piece of the real estate versus a fund where you own an interest in an LLC that owns the real estate. A tick, you actually have an interest directly in the asset. That can be good and bad. Since the taxpayer holds deed to the real estate as a tenant in common, the investment qualifies as a like-kind exchange under 1031. So I would say 99.99% of the people that we have that are in ticks are all part of 1031 exchanges. And that could be an entire another topic. And we've got a vendor that I know that would be great to talk about 1031 exchanges, but bottom line, you buy a property, you sell it for a profit. You don't want to take the profit and pay the taxes right now. So you enter into a 1031 exchange where the money never actually comes into your bank account. There's an intermediary that actually holds on to the funds and uses that to fund another deal. So you don't avoid taxes, you delay taxes. And everybody knows the power of money. You know, it's always best to put your taxes off legally into the future so that your money can multiply, and hopefully the tax code will be beneficial, or you'll look past, and then you let your children deal with it, or their children. So ticks are primarily for 1031. I got a smile out of Dave Ramsey. Many times a TIC sponsor will not be responsible for management of the actual investment, i.e. property management. So they can still hire property managers just like any other deal. TICs can still get financing like any other deal. Flip side is everybody's going to have personal liability in the TIC, right, Greg?
Yep.
Yeah, good answer, Greg.
Carol, did you want to advance the slide? I don't know if you have a slide for ticks.
I don't have a slide for ticks. That's why I did not advance the slide. Because I was going to put a picture, I was going to have Rob put a picture of a tick. And then I thought that was not nice. Because I said half of our clients have done very, very well on ticks. Takes the right personalities to work with each other and takes the right experience. Tick members can be subject to personal liability, personal guarantees on debt, based on the tick agreement. So again, it is a true partnership. I mean, it's not even a partnership, it's a true co-ownership. It's like a co-op. You're just as responsible as everybody else. And if you can't make a decision, if some make a decision you don't like, you have to understand you're married to them. That's why I go back to the marriage. You are married to your tick members, your tenants in common. You're married until you're divorced. The only way to get a divorce, just like in our country, you got to file a lawsuit for separation. And those, in our experience, have been just as ugly, if not uglier, than divorce suits. So simple rule is just be cognizant of who you're going into business with if you're doing a 1031 exchange. And listen, the reality is people do ticks with 1031 exchanges because it's the power of pooling money together. You can't really do a 1031 exchange with non-1031 investors. So if you can find 1031 investors, it's very difficult to do it the other way. If you can find 1031 investors that all are under the same basic timeline and want to roll their money, and you guys have the same personalities and the same work ethic, it can be a great deal. I would just say do your due diligence on your tick partners like you would do on your asset, and that will keep you safe. You guys can't see this right now, but I was going to talk about the syndication timeline, though I think right now that's not as important. We will send you our standard timeline of kind of the evolution of a fund from the moment you kind of find an asset to when you file your LLC, to when you raise capital, to when you file with the SEC, go over blue sky laws. So in the outline, which I'm kind of reading while I'm going through the slides, the next step, which I don't have a slide for, is a syndication timeline. And it's basically the timing of the fund. I don't think that's as important for this call right now. So when you guys are putting together a fund, there are 4 key elements, and 90% of you that are on here, I know, are already syndicators or very experienced passive investors. The 4 things you want to look for as an investor, and the 4 things you want to tell your investors, or I shouldn't say tell, you want to prove to your investors the asset will do with proper management. Number 1 is always capital preservation. You can't preserve the capital, doesn't matter. 2, I don't care what investors think they're looking for, they always want cash on cash returns. No investor wants you to tell them they're not going to get cash on cash returns for 7 years. They're not going to tell you that. If they are, I don't know what to tell you. They all want cash on cash returns. There's this little thing called tax advantages that I'm sure Dave Ramsey, again, he's the bottom of my screen, so he's getting a lot of airtime. Dave, 18-year Oban Scotch, it's my preference. Yeah, he knows. So the depreciation expense, I got him on mute, thank God. The depreciation expense, the accelerated depreciation expense, many investors look for that. Matter of fact, you guys that are doing 506Cs where you're advertising, doing general solicitation to accredited investors only, and we've done this before, target people that have just either gotten out of a deal or are looking for a deal that have profits, because you'll see more deals are done in October, November, and December with large per person, larger capital amounts than any other deal, because people are trying to take advantage of the depreciation expense. They can use that to offset some of their profits. So we see that often. We did a fund and we were raising on average $167,000 or $76,000 per person, which is typically high. And we had some big players of $600,000 and $700,000 a piece, solely for the 60% depreciation expense that got pushed down. So in other words, they put in $100,000 and they got a K1 for negative 60 grand year one. And at a 35% tax basis, I know Dave could figure this out quicker than me, but that's $21,000. So they essentially made 21% on their 100 grand on day one. It's the only time in the world that an investor will thank you for giving them a negative K. Don't expect them ever to thank you again in the same deal for a negative K1, but they will thank you that year for a negative K1. So it is always advantageous to see if you can find some deals, especially towards the end of the year, and you have to get it closed by the end of the year. The analysis for depreciation can be done in the first quarter of the next year, but you got to get it closed and you got to get that information out and done before they file their taxes. So anyway, those are the four things. Capital preservation. I didn't talk about the fourth one, capital gains. People love cash on cash. They also want to see something good is going to happen when you sell the asset. So in 5 years, 6 years, 7 years, 3 years, there's an expectation that the asset is worth more in 3, 5, or 7 years than it is today. If it's not worth more than in 3, 5, 7 years, your cash on cash should be stellar. It should be 15 to 20% a year to justify why they're not going to get something at the end. Typically, three things that sponsors look for, and this is more for investors, but it's also for new sponsors to think about. Some of you guys definitely don't do these, but we see them. Annual compensation, which is a fee to the sponsor. Typically, that's in the form of an asset management fee. The asset management fee is basically like 1 to 3% of revenue, typically revenue generated by multifamily or whatever. If you generate $1 million, 3% of that is $30,000, and it's typically paid out quarterly. So that means the manager or sponsors would get $7,500 a quarter. It probably is going to be more than that, but that's a fee that you'll typically see in a fund scenario, and it's a way to give a few bucks to the manager. Clearly, manager is not making its living off of 3%. And then the other type of fees that you see and that we see a lot of are what I call event triggered compensation. Event triggered compensation. So this is going to depend on your client base, your investor base, and depend on your experience with that investor base. We see lots of people that do 1 to 2% acquisition fees, just like a broker, because they have to go through all the due diligence. They've looked at 3 or 4 deals, maybe more, physically looked at, gone through due diligence, and they believe their time should be compensated for. And I'm not disagreeing nor agreeing. There are times where we've taken an acquisition fee, and there are times where the economics are good enough for us on the management side, it's not necessary. But typically an acquisition fee is 1 to 2%. I've seen some at 0.5%, and they're paid at closing, just like a brokerage. But if you think about it, on a $30 million deal, a 2% acquisition fee is $600,000. That's very lucrative for the manager and the syndicators. On the flip side, the investors sometimes get a little when they see someone getting paid $600,000 up front before there's been any performance on the property, and they're getting an asset management fee, and they're getting the next section we're about to talk about. So again, that's one of those things where you'd like to do a poll of your investors before you set out the parameters. So you do a poll, hey, who would be put off if we took a 0.5% or 1% asset management fee? Or you do a multiple choice, your preference, 0, 0.51, 1.52, but you also do it with what you expect the return to be for them. So there's a balancing act. That's one fee. A refinance fee we see as well. So going through the refinance process or a supplemental loan process on an existing deal, that takes time. It actually takes a lot of time. It takes effort and takes due diligence. It's almost like doing another refinance package. So there are there's a significant number of funds and syndicators where they'll charge a 0.5 to 1% refinance fee. Now that's only going to be a percent of the loan refinance. So if it's a $3 million refinance, it's 30 grand, but it's still 30 grand, and it's 30 grand to go help compensate the manager. And then the third fee that we see that's most likely used is an exit fee. This I think is overkill. This is me personally. So an exit fee means I helped sell the property, so I get a fee for the sales price, almost like a commission from a broker, but we already had a broker doing it. But because I had to go and do all the due diligence, blah, 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 I'm entitled to an exit fee. I personally have never used that because I structure deals where when the property sells, everybody gets a lot of money. And to me, that could be construed as double dipping, depending on how lucrative it is for the manager at the end. So an exit fee, again, is very similar to an acquisition fee. The difference, I would argue, is assuming the asset was sold for a higher amount than what it was purchased for, the manager added value. And so he or she or it is entitled to an exit fee. I think if you want your investors to sleep a little better at night, because you have to disclose all this up front before they even put a dime, maybe you structure the exit fee based on a percent of the value when it's sold, less the value when it was purchased. So then at least you're perceived as being on the same footing as the investor, meaning the better the deal is in the end, everybody plays, everybody wins. And finally, really the biggest way that managers or syndicators get paid is based on their split. Split is very simple. The split means, am I getting 10%, 20%, 30%, 40% of the profit at the end after everybody's capital is paid back? Typically, Greg and Cindy and I, we will see on new deals, very new deals, we'll see people in the 10 to 15% range, meaning the manager gets 10 to 15%, depending on how it's structured, of profit and proceeds after capital is paid back, and the investors get 85 to 90%. The more experienced and the better the fund economics are to its investors, you'll see that creep up to 20% to the manager, 25. We've seen 30. I've seen some. I mean, we're involved in some mineral deals where it's completely split. It's 70% to the manager and 30% to the investor. And some people are like, "Wow, that's crazy." Well, if it hits, especially in a minerals deal, if it hits, that 30% to the investor could pay the investor back all of its capital in 6 months. And then it is just a huge annuity for the next 5 years. So it's all based on risk and reward. The investors that are familiar with those type of deals don't expect it to be 30-70 the other way. They expect themselves to get the smaller percent because of the potential windfall. But in multifamily, strip centers, typical commercial real estate, you're going to run between 10 to 30% for the manager or GP and 70-90% for the LP. And the next slide, and Cindy, I'm going to pause because this will be the last section we go over because I see we are not going to have enough time. But the next slide we're going to talk about, this will be the last section, and then we're going to do the remaining section next week because I can see some people are falling asleep. Sponsors. Cindy, do I have any questions up until now?
Not on this section. So there's just one more question, but I think go through this first.
Okay. So guys, this is actually key. And this is something I'm telling you nobody does. Nobody does this. I don't understand why. And we see all sorts of, excuse my French, but shit happen at financing and happen later on in the deal because nobody does this. Guys, when you are picking your partners as sponsors, your co-sponsors in a deal, I was going to say you need to pick them like your spouse. I would say you need to pick them better than your spouse. Not saying that you guys have picked the wrong spouses by any means, but it is as important, if not more, because you're dealing with other people's money, that you make sure, and the first topic right here, the first bullet point is the personality, that the personalities fit, okay? There is nothing worse than being stuck in a deal with people that don't get along. Cindy, we see that often, don't we?
We unfortunately do.
Yeah, and I would say it could be as much as 50% of the deals. And it is unfortunate. And then, but then on the flip side, those 50% that do work, they'll do 13, 14, 15, 20 deals together. We got a guy that we represent, a team we represent, I think they're on like 27 or 28 right now. And they always work together. They've been doing so for the last 6 years. And so when it works, but you've got to make sure the personalities work well together. So to me, if I'm a sponsor and if I'm an investor and I'm looking at, I'm putting a lot of money and I look at, these are the people that are going to be reporting to me and, are we kind of on the same wavelength? But especially when you guys are sponsors and you're in charge of all that money, you have liability out there, personalities have to match. Second is the experience. Personalities are great, experience has to be earned. It's great that someone comes right out of college with a degree in real estate or a CPA or whatnot, but if they haven't had experience managing an asset or managing money or doing this specific asset, it's going to be an issue. So when building your team, you want to make sure that you've got experience. I personally try to find team members that have very good experience in different areas so that we all can learn from each other, but it also allows a separation of duties. While we all report to each other, we can have, you know, one person focusing on this task, another on this task, then you meet up with weekly meetings. I think that is the best way to do it. So I would, as a sponsor looking for co-sponsors, before you even find the deal, you always put your people together, put your team together. So you got personality, you got experience. Here's something no one does. Blows me away. Nobody does background checks on their co-sponsors. Greg, you're rolling your eyes. How many people do you know that do background checks before they get into deals with their co-sponsors? Right, right. And how many people wish they did when the lender starts doing its due diligence?
All of them.
Yeah. So guys, I mean, I don't understand. So I've worked with 4 different hedge funds, and you guys have heard me talk about this. That's 4 colonoscopies every day for 4 years in a row. That's how much fun it was working for hedge funds. We had to do, I think it was what's called a level 3 FBI background check, every one of the C-suite and with every one of the hedge funds before we could work with them. That means like had to get fingerprinted. I mean, we had to go through this entire and a personality test. Why? Because with one of them, we were using in charge of about $450 million of their money, but it wasn't even their money, it was other people's money. And they wanted to know what type of people we are, what our experience was, and what we weren't telling them. So I'm not telling you guys to go and do a background check at a level 3 FBI. I mean, actually I am, but you won't do that. So I've put some things because we help clients out sometimes. Someone wants to come and join their group as a partner. They've never heard of them. They ask us if we know about them. It's pretty funny. Like I'll do a Google search. Really, I'll do a Google search and I'll find out more information than I could ever find on someone. And simple sponsors don't really have the time or the think about doing that. But a Google search will show you an enormous amount on somebody. Asking for references, that's fine, but guys, come on. They're only going to put references. They're going to say good things. They're not going to put a reference of someone they spent, you know, time in prison for bank fraud. I doubt that. And I'm not saying all of your partners are going to be in there for bank fraud, but references are as good as the paper they're written on. That's my personal feelings. I don't use them for resumes. I wouldn't use them for a sponsor. So I think a Google search, social media, I love this. There are probably 20 of you online right now that have set up calls with us for the first time. And I'll go over some personal things about you guys. And you kind of look at me like, what's going on a Zoom call? Well, you're on Facebook and you're a Facebook friend and you post your life out there, just like people were asking me about, Dave Ramsey's asking me about the contractor that pissed my wife off yesterday. You know, so it's great. People like to talk on social media. Well, you can figure out what type of person you're going to be working with for the next 3 to 5 years and sharing liability with, and some of your investors will have their money with them. So look on social media. It takes you 5 minutes. Do not be afraid to ask your investor, your potential sponsor, co-sponsor, to do a credit check. I don't understand why you're going to have to do it anyway with the lender. It's unbelievable. They're going to do a background check. They're going to do a credit check. And Greg and Cindy and I know, I would say on almost every deal, lawsuits pop up. Sometimes they're not the same person, which is fine. Same name, different person. Many times they are the person. And then a whole explanation has to happen. And so 1, it's explaining to the bank. And 2, now you got to explain to your partners who you're already in a deal with and you've already raised capital. And so now that raises issues. So listen, everybody has some sort of shit that they had to deal with at some point in their life. So just because you had, you know, fell on bad times or whatever, assuming it wasn't heinous, you know, be honest with your co-sponsors and tell them ahead of time, hey, I dealt with this 5 years ago, 7 years ago, so it may pop up. Great. You know, if everything else checks out and they're a good person, that's your decision. At least there are no surprises. And quite honestly, then Greg, Cindy, and myself can actually give the bank a heads up. Hey, you're going to see this on their report, so don't freak out. We have an explanation. This is what happened. This is what they've done now. And believe it or not, it actually works. But by failing to disclose it to your lender and to your co-sponsors, you are creating a very nasty divorce very quickly. It could ruin you. So I would suggest those of you who might have some blemishes, you disclose it. I would suggest those of you that don't check on your partners, check on them. Check on them. I've had the world check on me. I'm a lawyer. I'm a title company. I work for 4 funds. We get checked on everything every day, all the time. And here's another thing I love. Why people don't ask, if you're bringing on co-sponsors, why would you not ask for a copy of their PFS, their personal financial statement? So some people are going to say, oh, that's too personal. Okay, then if you won't give it to me, I'm thinking about using, and I'm just going to use as an example, Old Capital as a lender. Can you send your PFS to Old Capital today so they can take a look at it and they'll let me know if we're going to have any issues? Because if there are issues on it today, the lender's going to ask you for a PFS if you're a manager. You will have to give them your personal financial statement. And if people are thinking you're worth $15 or $20 million and they don't have to go and find enough co-sponsors or key people to quasi-guarantee the loan up to, you know, $15 or $20 million, it's going to be a big problem. I've been in a deal like that where people don't have the net worth that I thought they had. And it's uncomfortable, not for me, but it's uncomfortable for them. And that's when you end up trading interest, percentages of interest in the GP when stuff like that happens. So I would strongly encourage you guys. I'm going to have this, again, you guys are going to get a copy of all the notes that go behind this. But I would strongly encourage you guys to really go through these items that are on this slide. A lot of you guys are doing deals with people you've never done before. I think it's great. I think one of the benefits or the positives that's come out of COVID is so many more people have been interacting through Zoom and Teams and all these other social media sites that they get to know people better, and they found more people that are doing things like them in completely different markets and want to pool together. But then again, this is like online dating. Online dating from afar. Still do your due diligence. I would do your due diligence. I said this in the beginning on sponsors, just like I would do my due diligence on my actual asset. I could hit this topic, or we can save this one for next week. Actually, I'll save this one for next week because we'll get a bunch of you people to get on board next week. Then we'll answer some questions. We'll open it up for some questions in a minute. But so I'm going to leave off next week's state of incorporation. I love this one. I love this because we, Greg, right, deal with this all the time. And I'm not going to go into the specific details because I truly want you guys to do this. And I don't want to do this 2 weeks in a row. Honestly, it takes a lot out of me to put these together. But I think this is a great topic. State of incorporation. Where do I incorporate? I'm not even reading off my notes. So if you're in Texas, and I would say 60% of you are in Texas and your assets in Texas, you should be incorporating in Texas. I'll give you 100 reasons why next Tuesday night. But if someone tells you to incorporate somewhere else, don't. You should incorporate in Texas unless a lender requires you to incorporate your entity somewhere else, which happens, unfortunately. And one of the reasons why you don't want to be incorporated there if you don't have to is something we see all the time, which is extraordinary legal fees for something that is stupid. So a lot of people out there a lot of groups out there are telling people to incorporate in Nevada, Wyoming, or Delaware. And I put Arizona here because Arizona is still a very favorable place to incorporate. Texas is a very, very favorable place to incorporate, and Florida is a very favorable place to incorporate. And ironically, I would say 85% of the deals that people are buying are in Texas, Florida, and Arizona. So you have three really good choices right there where you can spend lots of money and lots of issues, and you can create entities in Nevada, Wyoming, and Delaware. So we're going to go over what the pros and cons are. And this is not the entire session for next week, but this is the midway point about where you should or shouldn't incorporate. If you have a pressing question about it, email us. If you're about to file in one of those places, you're welcome to email us before next Tuesday. But as a quick example, guys, if you have, and not even if you have an incorporation in Delaware, correct me if I'm wrong, Greg, but some lenders require a Delaware legal opinion, correct?
Correct.
Because the lender is incorporated in Delaware.
Usually it's when they require the borrowing entity to be a
to convert to Delaware. So guys, we do when you're doing a loan over, I think it's like $5 million, you have to do what's called a lender's opinion. It is a joke. We have to opine to the lender. I have to sign off on an affidavit essentially that says everything that the borrower, our client, has done is accurate. Accurate LLC, accurate formation, blah, 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 blah. And we charge the client. What do we charge them, Cindy?
It's about $2,000.
It's about $2,000. And we charge it not so much because of the form. It creates liability for us that we have to show on our malpractice because we're opining to somebody that's not directly related to us, to our borrower. But we created most of their documents, so we know they follow the rules. So it's about $2,000. It is a form, guys. Fannie Mae, Freddie, they give us the form that we have to use. It's pretty funny. They give us the form for us to tell them that our client has done everything right. So it's kind of a joke, but it's just one of those things that has to check the box. And so we fill out the form and we verify the documents. And many times we have to provide a copy of the documents. Actually, we have to provide a copy of all the documents. So there's some work. So we charge about $2,000. Greg, let's go over some of the ones that you remember, because I know a really big one we did on one of our own funds.
Yeah, I've seen as high as about $15K.
$15,000. I didn't mean to interrupt you, but $15,000, and this is recent, for a Delaware law firm to take the form, fill in the blank, and quite honestly, get the information from us. We have all the information. $15,000 to our client. That's more than sometimes we charge our clients on smaller deals. It is unbelievable. And so why do they do that? They do that because they can. They know they will never see you again. So they don't care how much they charge. They really don't. They'll never see that client again. You know, the odds of them representing them for a Delaware entity is slim to none. And so they can essentially charge what they want. And you've got your lender saying, hey, in order for you to loan money, you know, you may have to be a Delaware entity. It doesn't happen that often, but it happens often enough where I'd say, what, 1 or 2 out of 10, Greg?
Probably about that, yeah.
Yeah, somewhere around 10 to 15%, depending on the lender. You're going to double your fees. And guess what? Now you've got to deal with, you filed in Delaware. And so you're going to have to file a tax return in Delaware. It may be nothing, but you still have to file it. And if your asset's in Texas, you have to register as, I'm getting into my topic for next week, but you got to register as a foreign entity in Texas and pay more than you would have paid if you had just filed an LLC in Texas, and you still have to pay franchise tax. Huh?
More than double.
Yeah, $750. Anyway, you guys want to get in on next Tuesday. It's not nearly as boring as what I went through today. I promise you. All of this stuff is good stuff. And then next Tuesday, I will send out a copy of the outline that goes into a lot more detail about everything we're talking about. So Cindy, this is a good stopping point because I said 7:15, hard stop at 7:14. Do you have any questions?
Just a couple, and you just answered one of them. People were concerned if they were going to get a copy of this, so they are.
Yes.
This is a question that says might be off topic, but can you create an LLC with an accredited investor and a non-accredited investor to invest in something that has to be accredited?
Greg, it's your favorite question.
It is. The answer is probably not. The SEC will sort of look through your new entity if it's formed for the purpose of investing in this new deal. So if its sole purpose is to invest, to essentially get around the rules of having all the investors be accredited, the SEC will look through your newly formed entity and treat it as though it's not allowed to invest, as if it has one accredited investor and one unaccredited investor. Or the LLC itself could be accredited if it has more than 5 million, I believe, in assets. If your LLC is not formed for the specific purpose of investing in that deal, then you are more likely to be able to do that. But the way that question was phrased, I'm thinking it's going to be formed for the specific purpose of investing in that deal, so probably not.
Yeah, and that's a very good question. We get that all the time. Oh, well, we're just going to pool money together so we can put 200 grand into this deal. Well, you can pool money together, but unless you're an accredited investor, and again, this is mostly going to be for 506Cs that require accredited investors only, because you can pool money together and be a sophisticated investor even if you have one or two accredited investors in it. That still can go in a 506B as a sophisticated investor. But Greg, don't they count each person in there as one of the sophisticated investors when counting your 35?
They would.
Yeah. So you have to be careful because if you bring a deal to a syndicator and it's got 35 members in it, and each person invested $5,000 and they're going to put 175 grand into your deal, well, you better tell that syndicator that it's got 35 members in it because they just used up all of their sophisticated investors they can have in their fund. And I guarantee you that was not their intention in letting you in. So that's an issue. There was a lot of talk on, I know you have another question, Cindy, but there was a lot of talk on Facebook about the amendment to the accredited investor. And I was laughing, looking at people posting about how great it is and blah, blah, blah. The friggin' joke. I think people just run out of stuff to talk about on Facebook. And so, oh, this is great. So I know you guys are waiting and I'm going to talk about it in detail next Tuesday, but I want to blow your minds tonight about how great it is for you guys. So the SEC has so graciously amended the accredited investor to include professionals. We're all professionals, right? So those of us that don't meet the number requirements, that means, we can invest as accredited investors because we're professionals. I don't think so. All it did was it allowed people that hold their series licenses that are already involved in these deals and raise capital in these deals to literally invest in these deals. It was the most self-dealing request that I've ever seen. There are no professionals that get to invest as accredited investors that were not monetarily accredited investors. They're simply allowing brokers and broker dealers and Series 7 and 65 and all those guys, they're allowing them to invest in deals they look at every day. So it did nothing for 99.99% of you and everybody else on Facebook, though everybody seems to be so excited about it. It also allowed, we'll just call it same-sex marriages to count as a marital union when adding spousal's income. I think many of the states would have already recognized that. So they just simply codified that by law. So in other words, if you were in the way it looks, the way it reads right now, it still reads, an individual that made $200,000 the last couple of years is going to make $200,000 this year and is continuing to be employed will qualify as an accredited investor if he is married or she is married and was assumed to someone of the opposite sex, then that number goes to 300,000. So the nice thing is if you only made 150,000 and your wife made 150,000, together you guys qualify. So they now allowed, what is the term they use, Greg? It's on my slide and I can't see it, but I was gonna say same-sex marriage, partners that are together can combine their income to qualify for accredited investors. That's great, but I think that had already been going on. So bottom line is the SEC did essentially jack squat for you guys. There are a couple other minor nuances, but they did jack squat. They've got some other things coming down the pipeline, but I love these people posting, oh, how great it is. And we can't wait, blah, blah, blah. So if you're a series holder, awesome. In 60 days, you guys can invest your money. But as far as expanding the accredited investor, it didn't do much to just about everybody listening in. Cindy, other question.
Yeah, and so there's several questions that kind of all pertain to the background check, so I'm going to combine them
Good.
for you. Basically, it's what type of background check do you recommend? What's a reliable source? And do we, as a law firm, offer this service?
Whew. Huh. So I'm thinking not about the first two, about the last one. I'll come back to the last one. So a background check, quite honestly, could be as simple as the same background check that you would do as a property manager on a tenant. It's not complicated. You're checking to see what their credit looks like, if they have any big outstanding bills. And listen, if you were going to work for the government, you'd have to do a criminal background check and a civil background check. And my argument would be, if you're going to partner with someone and you're going to play with other people's money, $1 million to $5 million to $10 million, you probably would want to know if one of your partners has been either indicted or convicted of, fraud or impersonation of someone else, or some type of crime relating to money or mishandling. Clearly, murder would probably be something you'd want to know, but most likely that person probably wouldn't be out and be trying to raise capital. But I'm not trying to be funny. I would highly recommend, and if they want to get it themselves and submit a copy, and it's within the last couple of weeks, I think that should be sufficient. You don't want to be confrontational, but I would appreciate if someone asked me that didn't know me well, I would appreciate it that they were checking all the boxes. Now I would turn around and ask them for the same thing, and they should expect me to. So that's the other thing, Cindy. I think people should be very aware of or cognizant of providing the exact same information they're asking. If I'm gonna ask Roxy what her background is, because I want to do business with her, she should turn around and ask me what my background is too. Great, we're both good, awesome. Let's go find another person, and we're good to go. So I would do that. I would definitely do a credit check. Listen, the credit check and the lawsuit check, your lender's doing that. So you're either going to find out today before you have your partnership finalized and you guys are married, or you're going to find out when your lender does it and you are so pregnant in the deal, you've already raised your capital, you're about to sign on a deal, and guess what? All of a sudden, you're the one who's holding up getting financing on a property. And now you have 40 to 70 investors that could come and sue you because you didn't tell the truth to begin with. So my recommendation would be yes. Can we do this? My preference is to say no. I don't want the extra liability. Property management company can do it. You can actually do most of this on some online sites where you type in your own information. Dave Ramsey may be willing to do it. He's kind of smiling, but he doesn't want to do that. It's too hairy for him. Yeah, I as a law firm, I wouldn't want to do it. Now, we do have people ask us, have we heard of somebody? Can we look somebody up? As long as it's not a client of ours. You know what I do? This is really hard. I looked at Dr. Google. So hard to look up on Google. And listen, here's the funny thing. If there's been a lawsuit or a crime, there's a really good chance that there's a pleading out there that pops up when you enter that person's name correctly. I'm just saying. And Facebook, well, if they're subscribed to some mass murder, page and some other stuff, it's probably someone you're going to want to think twice about or maybe just pass on. So there's some things you can do that are very simple that would raise yellow flags right away without you spending a dime and without you being intrusive on anybody. But to summarize, I would basically it would be like either an employer background check, same thing as that, or it would be a tenant landlord background check. And there are companies that will do that. It's typically going to run between $55 and $95. Make them pay for it. They want to be your partner so bad. What's $55, $95? Cindy?
Yes. So that really wraps up all the questions. And Meryl, I hope you'll get to read all the comments because everyone is thanking you and us as a team for how awesome this was. So
awesome. So
yeah.
We could give out just this section, Roxy, of the outline. I'm happy to, because we'll actually have this video ready in the morning for just this half. So, and I know I have Jeff on too, but if we can combine these two as one next week to get ready to people, that's great. But I think there's some good information on here that can probably help people today. So what I think I'll do is I'll cut this outline in half, send it to you, and then when you send this out tomorrow to everybody that listens, they'll at least get the first half of the outline. And again, we have a list of the chat information, and I'm fine with doing this. If you guys put your information, your contact information, to the extent you want to be contacted by others, put it in the chat box, and to the extent we can figure out a way to copy it over, happy to do that. Plus, you'll already have the video, so you can scroll through the video and you should be able to see the chat, right, Roxy, or no? Is that a no? Jeff's saying
No,
yes.
the chat will be separate. We can do that as a separate link.
Okay, so Jeff will create, so you don't even have to do, so Jeff will create a chat as a separate link. So if you want to put something in, I would say go ahead and put your information in right now. I see the chat numbers going up, because I do encourage people networking with each other, and this is about as close as I can get to happy hours right now, and I truly miss them. We had a lot of fun at our happy hours, and I don't see anybody drinking right now, which is very disappointing. I've got my Coke Zero because I've got to stay sober for this, but I'll definitely be hitting it after that. Real quick, I wanted to give a shout out to Nicole. Let me see if Nicole's still on here. She may have left. David Sifford. Oh my God, Ball's on. I haven't seen him in a while. Greg's on. So Nicole got off, I think. She's somebody we're working with. We do some consulting now on the side, which has been a lot of fun. And so Nicole, she'll get a copy because I saw her on earlier. She's not on, but she is a 31-year-old mom out of Minnesota. And she's got some interesting insight. She's doing a ton of storage facility operations up in Minnesota. And not only is she doing it, she and her dad's a contractor, construction company, have been doing very well. And so she's about to start raising capital, has a bunch of equity herself, but is in the process of starting to raise capital. And I was looking at a couple of her potential deals and very, very, very impressed. One, with how she put them together, but two, with just the market on the type of storage facilities they're building and the return. The current returns and then the projected returns are very impressive. So we may try to do a little series on storage, because I'm telling you, storage is not played out. People think, oh yeah, storage is gone. It's impossible for storage to be gone when you keep increasing the number of people renting properties. Ask Jeff, he just moved into a house. Jeff, I'm sure there's stuff you could have stored.
Yes.
Yeah. Now I upsized, so I was stupid. I should have stored everything before I downsized, knowing my wife was going to change her mind.
Now you have to fill it all up again.
Yes. So, but you guys should be happy because my wife and I are keeping America great again by keeping the economy going. Luckily for us, we keep Wayfair, Nebraska Furniture Mart, Costco, and everybody else who sells anything you could ever use to put together a home or put in a home. Yeah, so she's an interesting person. And there are a lot of other people. I know a few people are still on. David White, I saw, was watching. Had quite a few clients reach out to David. I'm sure he put his contact information in there about infinite banking. It's a great opportunity if you've got some cash, you want to leverage that cash and also protect it from creditors. He and Erica Neal have a great business going. They're also up and coming real estate syndicators, working on a couple deals right now. They didn't ask me to say anything, so I'm not. They're not promoting anything by any means. This is me just giving you some background on some of the people. Reach out to David, who's online. I'm sure he posts David White. You'll see it later. Ask him about the infinite banking. We've got a podcast on YouTube about infinite banking with Erica. It's very informative, also very entertaining. We've clocked Erica, and I believe she goes 0 to 60 in about 10,000 words. It is very impressive. So you need to kind of, when you watch that one on YouTube, and maybe Rob will make that available to Roxy just as a link she can send out tomorrow, but you want to slow down the speed of the YouTube video so that you can actually, she talks faster than anybody I know. And the amazing thing is she knows her shit. So she's not only talking fast, it's so informative. I got to get her to slow down so I can remember some of it because it's good stuff. But a lot of good people on. I want to thank everybody for being out here tonight and making the drive to our happy hour. It's very impressive. And I'll get this stuff out to you guys, and have a great week, and we'll pick this up next Tuesday. Thanks, guys.
Bye, everyone.